territory by global rating firm Moody's. The country now sinking into the CAA1 category, which means a very high credit risk, reflecting a higher risk of default. Moody's ratings now says that the country's outlook is largely negative and an upgrade of Kenya's rating is unlikely in the near future. Jasmine Wamboi explains.
Moody's rating committee sat a week ago on the 2nd of July. It was Kenya's debt rating on the table for dissection. At the end of the meeting, Kenya had moved from B3 status into very high credit risk, which they call CAA1, and with a negative outlook. This means that the country's risk of default is presumed to have gone up. So just who is Moody's?
Moody's is a credit rating agency, a global credit rating agency. They rate sovereign and corporate debt. They are typically a source of information for investors who want to know how creditworthy an entity is, whether it's a sovereign or a corporate.
The decision to downgrade Kenya came shortly after the withdrawal of the finance bill, with Moody's saying it was driven by the country's diminished capacity to implement revenue-based fiscal consolidation. This, they say, would have improved debt affordability, placing it on a downward trend. Moody's also saying that the government's decision to cut back on expenditure instead of increasing taxes will affect the country's financing needs. The global rating agency has also taken note of the heightened social tensions in the country over the last 2 weeks, acknowledging that the government will not be able to introduce significant revenue-raising measures in the foreseeable future. However, economists say this downgrade has come prematurely.
When governments are in the process of making budgets, it's expected there will be pull and push, especially in a situation where this government has pushed the taxes upwards in the last few months and years. And so it was expected that there would be feedback or responses in the negative about it. And so what you do is you wait it out, you see how it goes, and then after that, then you can review with full information.
This new rating and Moody's negative outlook for the country is likely to further increase borrowing costs for the cash-strapped government. Should the government opt to shun the international market and borrow domestically, experts say this could lead to an increase in interest rates. The government in a catch-22 yet again, with rising debt obligations and an inability to raise more tax revenue. So what options does the government have?
I think they need to focus on production. They need to put their money where their mouth is, because if you invest in production, in a few months' time, then the revenue will turn around. You see, with agriculture, you only need a few months. But even if we gave ourselves 1 year of good investment in agriculture, at a time like this next year, we will not be talking about high inflation, we will not be talking about importing food. We will have significantly affected our balance of payment and affected our currency.
The government ideally ought to have to keep spending below tax revenues, so that the additional money can go towards paying down debt.
Jasmine Wamboi, Citizen TV.